Hello all. Can everyone hear me and see my screen? Just do a sound check and a screen check first before we start. Great, excellent. So we'll start in a couple of minutes, probably about 1 minute's time. Yeah. I hope that you have a great week so far. Nevertheless, it has been pretty much for a while, right? In the last 2 weeks due to this Ukraine and Russia tension. Yeah. So definitely this particular topic about risk management will be pretty rather important aspect in the current situation right now. Yeah, so probably about a minute or so before we kickstart the webinar. All right, so let's get started. So it's 7 p.m. sharp here in Singapore. So very good evening, ladies and gentlemen. So I believe that everyone can see my screen as well as hear me loud and clear. So if there's anything, just give a shout out over here at the chat box. So I'll reply back to you during the webinar. But nevertheless, before we start, a bit of housekeeping. So as usual, I will actually run through the webinar. So this is a 1 hour webinar. So 45 minutes will be the content, we call it a presentation, that I will leave close to about around 10 minutes for Q&A. All right. So let's get started. So basically over here, yeah. So basically what we can see on my screen here over here is risk management, which is mastering the most important element in trading. Okay, so let me okay, once again, let me remove the thing. All right. So okay, so once again before we get started. Okay, sorry about that. Okay, I'm back. Okay, so basically today's webinar will be risk management. So I'll be sharing with you all various key concepts in risk management and how this particular concept are important in trading the markets, especially during a volatile moment at this point in time when there is no clear trending environment at this situation. So before we start, let's take a look at the disclaimer slides first. Yeah. All right. Okay, so basically about those who actually first time hearing me, I'm Kelvin, the market analyst for CMC Markets Singapore. So I've been in this market for close to 15 years. My focus will be on the global markets, we're talking about FX, global stock indices, as well as a bit of equities in the US market, the Hong Kong market, and the Singapore market. And my primary expertise is actually using technical analysis to analyze the sentiment of the various asset classes, the intercorrelation with them, and try to formulate a trading strategy from that based on a proper risk and reward approach. So I also do educational webinar rather than, I write articles about the commentary of the market, potential outlook based on the technical analysis perspective, and also this particular kind of webinar and how to actually use risk management or to incorporate risk management in our trading setup, which is very important to actually manage our risk prudently and robustly in this kind of highly volatile environment. And later I'll share with you how to actually kind of look at my daily commentary. So I publish daily commentary with charts attached, interesting charts that could actually kind of give us insights of the markets. So I'm very active on my Twitter, my CMC social media account, where I tweet every day. about the markets. Okay, so later I'll share how to actually find my Twitter, or even you could actually open a Twitter account. It's free, and actually start following me. And last but not least, this presentation webinar will be recorded, and after I will upload it tomorrow morning into my Twitter account. So actually you all can actually have a recap on the content. Okay, so basically, right, I would say that this is the trinity of a successful trader. So what are these three trinity? So basically, what you need over here is the most important is your mind, your psychology, your strategy. So strategy, it can be depending on what kind of strategy you are looking at. It could be short term, mid term, or long term. So today I'll not cover more about the strategy, because strategy we will actually cover it another day, because we can talk about multi time frame strategy, or we can talk about short term counter trend trading strategy. But most importantly, how do you, when you are trading, how do you keep your mind sane or rational while you are trading the markets? So this one I covered about 3 months ago, about late last year, about this psychology aspect of trading. So for this particular educational webinar, I'll talking more about this risk management approach. So basically, this is the trinity of a successful trader. First, psychology. You need to have what you call it, a proper mindset once you are trading the markets, because at the end of the day, it's actually you against the rest of the world. Okay, so unfortunately, trading is a zero-sum game. Then you have proper risk management, when to know when to cut loss and when to get out, and most importantly, do you think right now is it prudent for you to actually increase your position sizing? Okay, then nevertheless, strategy. What kind of strategy to use in the current market environment, and also do that particular strategy suit your personality? Right. So these are the things that we're talking about. So today focus will be more on this aspect, which is risk management. So all in all, right, you need these three: risk management, psychology, and proper application of the various trading strategies in order to become a successful trader, or I would say that to have a proper trading plan. Okay, so now these are the before I talk about the risk management, right, we need to understand what are the deadly sins of trading. Okay, so usually these are the most commonly deadly sins of trading that most of us, even myself, sometimes got seduced by it. Okay, so I always tend to keep myself a recall about this daily scenes of trading, and try to minimize these actions. One it starts to actually trigger into my mindset is number one, averaging down on losses. Okay, so why people tend to average down on losses? Because of number one, we tend to be a bit of egoistic when we trade the market. Because let's say, for example, if I have a view that Aussie dollar is going up, so I long Aussie dollar, right, against the USD. But if Aussie dollar doesn't go up and keeps coming down, okay, so instead of getting out, I need to know when to get out, because the market is telling me that I'm wrong in my initial direction, right? So in terms of trading, right, it's okay to actually have a view of the market or forecast the market where it's going, because trading, you got to have a view, right? Either you're bullish or bearish on the market. But however, if the market goes against your view, that means my initial view was bullish Aussie dollar, but Aussie dollar don't go up, instead keep coming down to a exact level. This level, I got to predefine this level to tell me that, hey, I'm wrong in my direction, I got to get out fast. So you cannot, there's no if or buts. That means you cannot say that, hey, what if I cut loss, the Aussie dollar start to rebound? Because some of us has this kind of mentality. Yeah, I know it may rebound, but what if it doesn't rebound? Then most of us, because of ego, we keep reaching down. We buy lower of Aussie dollar, but instead of Aussie dollar going up, keep coming down. All right, so that's one of the daily sins that we tend to get seduced to because of the ego impact of it. And also the next thing is over trading. Okay, so this over trading will come, right, when look at the FOMO, fear of missing out effect. So this will come when you are in a winning streak. That means, let's say for example, we're talking about ARK ETF. So ARK ETF in 2020. late 2020 all the way up to the second quarter or the first quarter of last year, 2021. It has been in a very strong uptrend, all right, close to up to what 30 to 40%. So let's say, for example, you already make 60% from ARK ETF, okay, then you tend to actually keep on trading because you know that, hey, this is your big winner. But the thing over here is that if you overtrade into ARK ETF, that means you allocate too much capital into ARK ETF, but you do not have a proper exit strategy. If ARK ETF change the direction, reverses, which will happen late last year, and because of the earlier over trading, and you do not have what you call a proper exit plan, you realize that, hey, whatever your initial gains has been evaporated, and was still for those who refuse to take profit. Okay, so the key thing about this over trading over here is because past performance, you are making very good based on your earlier judgment of the market. So you believe that this past performance, which is you get it correct, may persist or continue in the near future, and you keep on trading on that previous past performance, the direction of the previous past. That means you keep having a bullish view on ARK, and you keep adding on a long position on ARK ETF. So that's what we call over trading, and you do not have a proper exit plan when ARK ETF starts to reverse from the initial bullish trend. All right, and the next thing is called trying to be a hero. And also, okay, before I talk about this FOMO effects over here is that you join your friend. Okay, so let's say for example, your friend has already bought ARK ETF in let's say late we call it early last year, and he made about 30%. And he said that, hey, I make 30% on ARK. Why not you trade with why you didn't buy or have a bullish view on ARK? So that was actually you came in pretty much later. So because of the fear of missing out, you didn't do a proper evaluation of ARK based on a proper trading setup, and just enter based on companionship from your friend. So that's considered as well as a FOMO effect from here. And the next one is trying to be hero. So what is trying to be hero over here is okay, one example I share with you is in these few days around, especially those who are trading the SPX 500, the indices of especially the US indices, the Nasdaq 100, the S&P 500, because it's very volatile. It actually came down on an intraday basis about 1-2%, and some of us may not be nimble enough to actually try to catch this falling knife. So let's say if they manage to catch let's say if you're down by 1%, so you actually try to go long at this point in time. But however, the markets can continue to actually extend on the downside slightly further than what happened earlier on in late last week on Thursday and Friday, and continue on Monday. So the key thing over here is if you want to catch this, play this kind of a very highly volatile environment due to news, because right now there is actually other aspect that is actually happening in the market rather than sentiment, which is news flow. And the geopolitical news flow is like a toss of a coin, because unless we have a direct line to the party involved, which is Russia President Putin over here, to know what is action. So if you try to actually kind of catch this kind of falling knife the situation without a proper trading plan, that means you need to know plan as in manage your position. So instead of what I call it, trying to be bullish in 5 lots of SPX, why not half it become 2 or 1 lot? Because at the end of the day, there is another element that is pretty much fuzzy in the marketplace, which is the geopolitical risk, and it can be a binary a scenario. Is either 1 or 0, and there's no way we can predict that in advance in terms of we call it momentum or sentiment. At most, what we can do is that from technical analysis, it was us to only highlight the key levels to monitor once the price actually hit that level. All right, so this is what I call trying to be a hero, catching a falling knife without knowing, hey, why this knife is starting to fall, and your trading strategy based purely on technical analysis only, is it sufficient enough, right, to actually help you to do a proper risk management or proper risk management trading setup. Okay, now next over here is the 3 successful factors of trading is, yes, I will select trading setup based on the appropriate reward risk ratio and ability to know what is the maximum loss per trade. That means loss that you are comfortable with, and most importantly, when to take profits. And this when to take profit over here is also pretty much applicable to the current, the given, I mean, the current context of trading. So let's say, for example, if you are trading in the US stock market, the indices during this point in time, market is pretty much volatile. So if you realize that there is no clear trend at this moment, except that the index is stuck between a range. So once you identify the short-term resistance of that range, the index hit that short-term resistance, it will be prudent for us to take some profits if you are making. That means, i.e., this particular environment here, we got to be nimble because there's no clear trend, and we are subjected to the risk of geopolitical we call it noises, which is binary, and we can't have what we call some tools to allow us to have a kind of a leading or a anticipation direction, to anticipate the direction. So if this kind of environment, we got to be nimble. So if, how about yourself, if you are not suitable to trade in this kind of environment due to time or the luxury of time, then I would say that why not stay out and wait till the situation gets clearer, and there will be a better trend to actually trade with the trend. All right. Now, next over here. So this is the scenario I'll share with you all is why, because it will affect our behavior. This is the ideal world versus the real world of trading returns. Because so now we talk about the ideal world, right? Is every time I place a trade, I make 10%. So let's say if we start off with $100, 10% return for the first trade, it will go up to 110. Then the next trade, we get a 10% return again. So these are the trading, a perfect world trading system. You get 1-to-1, and after 1-to-1, you make another 10%. So the end result is 103. So this is the perfect scenario. So you have first win, second win, third win, all winning trades, and in the incremental of 10%. So this is a very perfect world, nice trading system that everyone hopes to achieve. Decent, not over exaggerated, where I make what 30 or 40% per trade. So this one 10%, 10%. Even though you do it with leverage, yeah, pretty decent as well. Non-leverage, better still. Okay, that now. But however, right, in the real world, this tends to happen. Your first trade, you may lose 10%. All right, means your capital down to $90, and the next trade you may break even. Okay, 1990, so you're still down by 10%. So next trade over here, you're able to spot a multi-bagger and you go up by 48% to hit the end result of 133. So what we could see over here, right, is the path of achieving this end. I will say that the end value at 133, we may not be going in this perfect direction. It will be like humps. It will come down, tend to come down, then break it, we call it 0%. That means there's no change, and suddenly you're able to spot a multi-bagger trading setup and went up to 133. So this is the real world scenario. That means it's a bumpy ride. So given this bumpy ride right over here, that means we know that the next trade right will not be always be a winner. There will be losers and there will be a winner. And sometimes the winner could be big, and sometimes the loser could be small or even bigger. Okay, so that means instead of 90, you could actually drop to 20% from here as well. So the key thing is over here, right, is at this moment in time, how do we actually prevent ourselves from getting losses too big? Because we know that the real world, right, is not a perfect smooth sailing path to reach the end value. So there are in betweens, there will be losses. Okay, so how do we manage our losses that, hey, what if it turns too big? The next level, right, to go up to hit our end target will be tougher. That means we need to have a higher return. All right. Yeah, someone asked me, will this video be uploaded on CMC YouTube? Yeah, the answer is yes, it'll be uploaded. All right. Okay, so now this is what I call, okay, look at this. So let's say if we were to have a capital loss of 2%, to cover back is 2%. All right. So if I were to increase this capital loss, so let's say if you go up to 10%, you realize that, hey, in order to cover back your initial capital, is slightly more, 11.1. And you realize that if your losses gets bigger, that means the path gets more on the downside and you start to lose 50%, you realize that you need to have 100% to cover back your losses. That means your next trade, in order to make back your capital, that means instead, before making a decent return, this only make back your capital, you need to find a trade setup which is 100%. Or you go and leverage, which is hopefully that you could actually make back your capital, your losses. But if you don't, your losses will start to expand again. So let's say if you have a 70% initial, 70% loss of your capital, you realize that your percentage to recover back will get tougher. I mean, that means it means that the more capital loss, the percent recovered to cover back losses grew exponentially to the upside. That means it gets tougher and tougher for you to actually cover back, or for us to cover back our losses. That means we will tend to be, we tend to over leverage, hoping that, hey, the next trade we can cover back that losses. But what if the next trade doesn't cover back the losses? Your losses grow bigger and bigger. So the only thing this system, right, can work, we call it the martingale system. So the martingale system will work. That means you keep on increasing your bet, hoping that the next bet will cover back your all the way back your losses. Is provided that you have unlimited cash or unlimited capital. So the only way you have unlimited capital is unless you are the Fed. Okay, that could actually print dollar or print US dollar into the financial markets. But unfortunately, we are not the central bank or the Fed. That means there is actually a capital for us to actually to say that, hey, that's the end game. That means we have limited capital. So the key thing over here is okay, sorry, is should have, we call it a NT. Okay, there's a spelling mistake over here. Okay, it's anti-martingale system. That means, i.e., if we have a loss, we will halve a bet. That means if we face a trade loss, the next we call it capital that we'll place. So let's say if I have the first the first trade, I place $100 worth of trade. Okay, so this trade I lose money, the next one will be lesser than $100, so I could halve it to 50. Okay, so I only double my trade size provided there is a gain. All right, so I know that whatever the next trade I lose, I more or less will tend to break even because I use that gain that I have from the previous trade to actually cover back the new loss. Okay, then now you all know that the key thing is, how do I keep my losses to a minimum, to a not say a minimum, to a level that I will not go bust so fast. Okay, in other words, do not go bust so fast, because at the end of the day, when it comes to trading, right, the most important thing is longevity in the market. That means we need to have a capital for allow us to actually ride the to allow us, pardon me, to actually ride out the volatility, and to have sufficient capital to actually take the next available trading setup when it happens again. Okay, rather than just immediately throw all your capital into the first trading setup that you saw. Okay, so this is what I call a percent risk model. So at the end of the day, the key of this percent risk model is not to show hand like casino, like you call casino to show hand, is to actually preserve your capital. Okay, and we start to trade in small sizes, and we build we call it your trading account in baby steps. All right, rather than you start to see what I call a very what we call a huge potential gain at one point in time, and suddenly your this gain will evaporate into huge potential losses. Okay, because we do not want that to happen, because at the end of the day, it will create a lot of negative psychology in your mindset, and which will actually impact your trading strategy as well. Okay, so now, so let's say, for example, we have a trading capital of 10,000. All right. So this trading capital of 10,000 over here, I will set a maximum loss per trade is 2%. And some of us will be much more conservative. So I will set it at 1%. All right. So then it actually based on the number of units to trade, will be based on the risk per unit. All right. So this, let's say, for example, this is my trading setup over here. Okay, on the, it's a very short-term trade on the SPX 500. So let's say, for example, I will not go much detail on the trading setup, but most important is here, I want to share with you, based on this trading setup, how I use it to calculate my risk per capital. All right. So if then from there we will calculate the number of units to actually trade in this particular trading setup. So let's say, for example, based on this trading setup here, we found that the risk reward ratio is pretty attractive, above 1, which is 2.34, and the entry minus the stop loss over here will be my risk per trade. That means if I were to take this trade, and if I'm wrong, that means the trade starts to, this is a bullish trade setup, instead of going up, it actually comes down and hit the stop loss level, which is 3626. I will lose 61 points or 61 ticks, okay, for this particular trade. Okay, so based on this expected risk, right, I could actually calculate how many units for me to actually go long in this particular, what is a bullish trading setup, to go long without losing the capital that the 2% risk capital. So basically, this is how it works. So I have an initial trade capital of 10,000. 2% of 10,000 is $200. So just now, the expected risk per unit is 61 based on the calculation. Okay, let me go. In fact, over here is the entry minus of the stop loss. So if the price, instead of going up and it hit below this stop loss, we got to get out. Okay, which is at 61 points per trade, per one trade. So from there, I use 200 divided by 61, 3.27. So we can't trade fractional, so we round down. So maximum, so the maximum units that I could go long is 3 units from here. And definitely we talk about a bit of advance, because you all know that let's say if you have really entered your position over here, depending on the instrument itself. So if the instrument is subject to overnight risk, that means it's not a 24-hour trading market. There's a risk of a gap up or gap down from here. So sometimes we may need to actually use a guaranteed stop loss to actually we call it prevent us to actually hitting beyond the 2% trading capital if the price actually gap down instead. Okay, so this is more of a advanced we call it technique to actually help us to actually has an ease of mind that we know that for we know that we have already set that as a maximum loss for this trade, which is $200. But definitely, if we were to actually use that guaranteed stop loss, we'll pay a slight premium for that. Yeah. Okay. Then over here, the next thing over here is that, okay, so we know that we already calculate the stop loss, right? The stop loss level to help us to actually not stop loss, the 2% risk model, pardon me, to help us to prevent us from over trading and to keep every trade at a level that we initially know that this is the maximum loss that we could actually have if the trade goes against us. And definitely, if you're talking about, if you're looking to actually look for a market that has that is not 24-hour trading, or there's a possibility that you hold your position overnight and they're subject to actually, because it's not a 24-hour market, there'll be actually gap up or gap down, then some of us may actually consider using a guaranteed stop loss to actually at least we have a peace of mind that this is the maximum loss indeed based on the guaranteed stop loss. And we also but got to pay a premium for that, right? So now, so with that 2% risk capital, we understand the concept, how to apply that, and the principles behind it. The next key thing, right, in terms of high probability winning age, so everybody talk about this positive expectancy. So what is positive expectancy, right? It's actually into two parts. One is called the accuracy edge and the monetary edge. Okay, so the accuracy edge, right, is we are hoping to obtain more than 50% of profitable outcome in our trade. That means if I do 10 trades, out of 10, 6 trades are profitable. That means 6 trades hit my, we call it expected direction, and 4 is losing trades. So this 50%. Then the next thing is about the monetary edge. So out of these 6 winning trades, right, how is my reward risk ratio for these 6 winning trades? Are they do I take in more risk, or my reward is more than the risk? Okay, so the key thing over here is that to have a good monetary edge, the expected reward is actually should be more than the expected risk in a trade. Okay, later I'll show you why is it important, the example. Okay, so uh, to actually I would say that we need to do a bit, we need to keep a trading journal. So to find out, in order to find out this your current expectancy, that means you need to have a minimum of 50 close position, the more the better. And can calculate, or I would say calculate your average winning trade and losing trade in dollar terms, and calculate the percent of winning trades and percent of losing trades. So this is how it works. That means over here, your average winning trades in dollar term times by your winning trades in percentage minus of your average loss in dollar terms, then times by the losing trade in percentage. Then this will give you the expectancy. So if you start to see a positive amount, that means, i.e., your trading, your style of trading is, I would say, acceptable. And then you can go back to find out that, hey, why is it acceptable? That means you got to monitor, examine each of the individual close position. So you could be using the a strategy that is right during this point in time, or the strategy that you use actually suit your style of trading, depending on the instrument that you trade in. So this is more of what you call it, the examination part of your trading journal. But more importantly is that I want to share the concept of this expectancy. Okay, so this concept expectancy, let's say this is a strategy A over here. So this particular strategy A, you have an average win of 2,000. That means out of the 50 trade, you make, let's say your average win of that trade, of all the 50 trade, the 50 trades is 2,000. Your average loss is 1,000. Your winning trades percent is 40%, and your losing trade percent is 60%. So you plug that into the formula over here, it gives you $200, right? So if you look at this is your win-loss ratio. So your win-loss ratio is 0.67. Yeah, so this is your win-loss ratio over here. So that means at the end of the day, right, your losing trade is more than your winning trades. This is less than 1, so it's 0.67, your win-loss ratio. So it's still positive. Okay, so let's look at this strategy B over here. So your average win and your average loss is the same, 1,000, 1,000. Okay, but your winning trades and your losing trades is 40% and 60%. Still the same, But however, if I plug this into the formula over here, you realize that it's negative. Why? Because of the risk reward ratio. So if you look at your risk reward ratio here is 1. What's this average win, average loss? That means for on the average, that means your expected reward for your reward for that trade is on average 1,000, but you also lose 1,000. So your reward risk ratio is 1 over here. But because your risk reward is 1, and your win loss ratio is less than 1, that means there is more losing trades. So at the end of the day, your performance, is actually negative. But however, if you look at this situation here, this one, the win loss ratio is also less than 1. But because you get your trades, your reward risk ratio is 2. That means your winning trade on the average is able to cover your losing trade on the average, because of the reward risk ratio is more than 1, which is 2. And that could actually offset your trading strategy, which has a win-loss ratio of less than 1. That means what it means over here, based on these two strategies, is even though you get your directional bets wrong, or I mean, even though you didn't hit your directional view that well, this trading strategy. That means uh, most of the time you are wrong in your directional view, but those losing trades has a lower risk, and the winning trades has a higher, the reward ratio is higher. So that could actually cover your low win loss ratio. But however, if you take equivalent reward risk ratio, or still this is less than one, you realize that your expectancy has starts to turn out negative from here. Now, let's share another strategy. This is called strategy C. All right. So strategy C, right? This one over here is that your reward risk ratio is one because of the average win, and the average loss is the same at 1,000. But over here, you realize that your winning trades and losing trades are much better. Okay, it's positive. So this is 60% winning trades, 40% losing trades. Okay, so what it means that even though my reward risk ratio here is not more than one, but I get positive. Why? Because this particular trading strategy that I use able me to generate more winning trades than losing trades. Okay, 1.5. Okay, then over here, if I were to look at this strategy D, okay, my reward risk ratio is 2. That means I have a reward risk ratio on the average of more than 1. And my winning trades and losing trades is still the same as strategy C over here. Okay, the reason why is it higher positive? Because I actually get a better reward risk ratio trading setup for every trade on the average. So what it means from this 4 strategy over here is this: your reward risk ratio and the win loss ratio trade-off. Okay, so that is formula of 1 divide by bracket 1 plus reward risk ratio. That means, i.e., the higher the reward risk ratio for the on the trade on the average, the required break-even win rate will decrease exponentially. That means, in order to get positive, so now we talk about positive expectancy. So let's say, for example, in order to achieve positive expectancy, I work on the reward risk ratio first. That means if my reward risk ratio is 2, at a minimum 2 on the average, you realize that in order to achieve, we call it break even or positive expectancy. Okay, so let's say break even now, is that my required win rate, okay, pardon, my required win rate to break even is 33%. Okay, at 2 is 33%. So in order to have a slightly higher, let's say 35% or 40%, I'll have positive expectancy. So if my reward risk ratio, I will increase more, let's say 3, my required win rate to break even will be 25%. All right. So if my reward risk ratio is only 1, my required win rate to break even, I need to be 50% over here. That means what you could see over here is this. Yes, it depends on the trading system that I use. So if my trading strategy has a very high win rate of, let's say, 67% to break even, that means I could actually have a lower reward risk ratio. Okay, so this is how it means. So if over here my win rate is actually 50%, I can have a reward risk ratio of 1. All right. So the key thing over here based on the table, right, is actually the first thing, the first thing to have to keep this positive expectancy, right, is we need to find trade setup with a higher reward risk ratio. That means monetary edge, so which plays a major contribution to the expectancy per trade. So once you get the monetary edge right, that means to hunt for good, decent reward risk ratio, more than 1, I would say reward risk ratio of more than 1. So you could actually have, it's easier for us to actually achieve positive expectancy based on the table that I shared with you earlier. Then the next step over here is to improve much further of your, to actually enhance your positive expectancy over here is to improve our accuracy edge, that means the win rate. of that trading strategy. All right. So this is the concept I share with you all. So this is the what I call it a concept that we can actually apply to the to actually look for trading call it when you look for trading setup over here. But definitely this is a concept over here. But the next thing, it takes a lot of trial and error to actually fine tune your what I call it accuracy edge, especially the accuracy edge. Why? Because accuracy involve the amount number of wins versus number of losses. Because let's say, for example, right, if you are used for trend trading strategy, but what if the instrument that you use for trend trading doesn't work now at this point in time? That means suddenly there's no trend. At this moment up, example, if you are looking at trading the 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 SPX 500 or the Nasdaq 100 in the last couple of days, that means there's no clear trend at all. So if you use that trend trading strategy on the SPX 500 or the Nasdaq 100, you find that hey, you get whipsaw here and there. So it all depends on a bit of a lot of practical trial and error, and how do you adjust your situation from here. Okay, so we're talking about adjusting on this situation, right? You also got to understand, right, how the different market correlates to one another. So sometimes, right, we tend to trade more than one instrument, which is okay at any point in time, but definitely not too much that we can't manage the position over here. So we also got to understand what is this correlation risk that is we're talking about. So correlation, right, is actually a statistical number between -1 to +1. So positive means that two instruments are positively correlated. Negative means the two instruments are negatively correlated. That means one positive one means they move perfectly in lockstep together. Negative one, that means they move perfectly in opposite direction. So it has a maximum value of positive +1 and -1. So traditionally, if we start to see a correlation of 0.8 positive to 0.7, is pretty strong on the direction that they move in the same lockstep over here. So this is what it means. If I were to do some statistical analysis, so if it's 0, that means you plot the two instruments over these two axes, you see that there's nothing. So this is very low. So this is pretty high, 0.9 very clearly, and this is 1 over here. And if this instrument goes this way, it's negative 0.5. Over here, you have a high negative correlation with negative 0.9. Put them together. Then over here, this is -1, which is a perfect correlation over here, right? So now the key thing over here is when it comes to trading, right, correlation can actually increase or decrease your risk. So let's say, for example, if you long or short the two instruments that are positively correlated, that means they move together, your risk increases. That means, let's say, for example, if you long Singapore stock, you long DBS, you long OCBC, because overall they move hand in hand together. So that means I have a double risk exposure on these two stocks. If instead of them, I have a bullish view, but suddenly if the price starts to collapse, because they two have a direct correlation, I will have a double whammy of risk. So what I do over here is that some of us may get a negative correlated assets to trade. That means if one rise, the other falls. All right. So then also don't forget over here is that there's caution over here. So this correlation is based on past observation and data. So sometimes due to macro factors, the correlation can actually change over time. So once it changes over time, right, we got to be alert as well. So this one, it actually takes a lot of practice to actually how to see this we call it changes. So one of the dynamic changes that you see, it tends to be if you look at gold and USD, because most of us tend to believe that once USD starts to fall, gold will tend to rise. Sometimes it may not happen during that period of time. So let's say, for example, if we were talking about if you're trading of these two SPX 500 and the Nasdaq 100 over here. So let's say if both of them are this very clearly, right? If you look at the last, so let's say, for example, if I'm trading in the short term, I'll tend to look at the last three to 6 months of the price movement. That means the Nasdaq 100 SPX 500 is moving in lockstep together. All right. So very clear. It came down also. It also came down as well during this portion. From here it goes up. All right, and here it came down slightly over here as well, and even this period of time. So what it means that over here they are positively correlated. So if I were to enter two trades at the same direction for the SPX and Nasdaq 100, that means, let's say for example, if I long two lots of Nasdaq, I long two lots of SPY 500 or SPX 500, you realize that I will be overexposing myself to similar risks. That means if I were to get wrong on both of these trades because they move directly that means they move hand in hand. That means what it means that if they come down, it means if Nasdaq 100 come down, SPX 500 will also likely to come down. So my risk exposure actually increases because they are positively correlated. So the key thing over here is once I start to see this kind of correlation in the past, I mean, by looking at 3 to 6 month behavior over here, definitely I will only choose one instrument to actually trade. Yeah, they say that if I have strong conviction, I could trade both. But what if it doesn't mean that a strong conviction, right? You'll be 100% correct. You'll be exposing yourself to more risk if you are wrong because they are positively correlated. So the key thing about trading over here, right, is not about how good in your conviction or how good you are forecasting the market, but rather how you manage your risk in the market by doing what I call a rational and a sensible trading setup. Because we know that, hey, if I take these two trades together hand in hand by getting two lots of SPX 500 and two lots of Nasdaq 100, both on the long side, that means I will be having 4 units. What if it goes against my direction? My losses will be much higher if I were to enter both of these two trades. So why not just choose one of the two? Because we know that the two move hand in hand. Okay, so the key thing over here, we always ask myself in trading is that yes, we can anticipate the next move of the market, but bearing in mind that as traders, we also need to know that, hey, what if our view are wrong? How do we preserve our capital when our view is wrong so that we could have sufficient capital and will not hit what I call the gambler's ruin problem where our capital get depleted very fast and we keep on topping up our capital. So at the end of the day, right, we could actually cannot achieve the targeted return that we have, and we start to actually saw tremendous damage to the trading account. So we do not want that situation to happen. And also, the key thing is that when it comes to trading, I've been there before. Once your losses get bigger and bigger, whatever initial plan that you have will start to go haywire. That means you start to take on additional risks. You start to doubt your trading strategy that is, actually works fine in the past, and you start to do all kinds of fine things to actually to actually hoping that your next trade will actually able to cover back your losses as soon as possible. So we do not want to create this kind of negative spiral of negative feedback loop uh, once you're trading the market, because it's an emotional game. So that psychology aspect of it, which is important as well. So now the next one I'll share with you, how do I adjust it? Okay, this is very important. This adjusting of position size during losing streak. Okay, so same thing like I said earlier on over here is that when it comes to trading, yes, we can anticipate the direction that we have. That means we can have a view of the market. So what if suddenly the market goes against us? Okay, I have let's say the last few days I'm trading the US stock indexes. So I keep on going long, hoping that the price will rebound much further. But what if I get cut off twice? That means I got stop loss twice. I long first time, the price came down again. I long the second time, the price came down on the Nasdaq 100. I mean, it dropped further. So let's say if I were to look at a long position at, let's say at 14,000, so instead of going up to 14,500, it dropped from 4,000 to 13,900. Then from 13,900, I look to enter again and hoping to go up to 4,003. Instead of going up 4,003, it dropped to 13,700 next time 100. So I already have two losing trade because it hit my stop loss. So the next trade I would take, right, I got to adjust my position size by the factor of 2. So what does this mean now? So let's say if my account, okay, so it depends on this is considered as your total losses. So let's say if my account now, based on these two trades, that I lose drops to 10%. That means negative. Now I'm down negative 10% of these two trades. Okay, means 5 plus together negative 10%. So I will assume this account loss by a factor of 2. That means I lose more times 2. So it's negative 20% now. So let's say my account has my initial account has a 20% account, 20K account. So negative 20%. So this is at times 2 instead of 10% of 20K. I get 20%. This is my initial account of 20K. That means I lose out. I lose 4,000. Okay, I lose 4,000 means times 2 is instead of 2,000, I lose 4,000. So my new balance, right, will be 20K minus 4K of 16,000. That means I force myself to take a bigger loss, but this is not a realized, this is not my realized loss. Not so this is not my realized. My realized loss is much smaller, but I force it to make it bigger arbitrarily. So my new balance, right, this is an arbitrary amount, 16K. So I'm forcing myself to take lesser trade. So I still keep it 2%. So instead of 2%, my reduced risk, my 2% will be 320. That means I try to reduce it my next trade 320. So if I were to do the normal risk, right, so it'll be instead of 16K, that means I'm using the actual loss, which is 2K minus 2K. That means my normal risk will be 2% of 18K. So this is the exact amount that I actually lose. This is the exact balance amount that I have after deducting of 2,000, which is 10% of 20K. This I would get 360. So over here, what I did over here is that I'm forcing myself to have a larger arbitrary losses, so I could actually reduce my trade size. Okay, so this is one of the way, right, that we could actually manage our risk if we were to actually maintain that 2%. Okay, or some of us, instead of doing this reduce by factor of 2, I from this 2% I could put it to 1%. Yeah, you can possibly do that as well. So that means the next one, if you lose, right, you will do it at 0.5% of your trading capital. So depending on how you want to look at things, but most importantly over here is that once you're in losing trade, right, you got to reduce your maximum risk for the next trade over here. That means two things is possible. One over here is to prevent us from getting further losses. Or second over here is that if you start to see, to me, right, if I start to see 3 losing trade, I will actually stop trading using that trading strategy. That means, i.e., that trading strategy doesn't work in the current environment for the instrument. That means if I start to see 3 losing trade on Nasdaq 100, that means the strategy that I use doesn't work on the current situation of the Nasdaq 100. That means I got to reevaluate that situation. Okay, so yeah, so basically I covered the key concept of this risk management. Okay, that we have over here. So yeah, so right now it's just 7:50. So just nice, we have 10 minutes of Q&A over here. So just feel free to actually chat over at the chat box over there, and I will actually answer your questions. Yeah, so we have 10 minutes. So anyone just feel free to actually shout out over here if you have anything that you want to ask me regarding about the risk management techniques that I share with you. So I understand that it's a 1 hour webinar. This I try to cover the what you call it, the context of it, and also the we call it the foundation on how to actually apply such techniques here. Anyone have any questions on here? Okay, someone asked me. Okay, let me expand. Okay, do we need to check macroeconomics or just focus on the techniques? Okay, so I will say that over here is yes, we need to actually go hand in hand when we are trading, especially if you are trading on the short term. Okay, let's say how do I do it over here? Okay, let's say if you are trading on Fed FOMC. Okay, as you know that Fed FOMC outcome is a very volatile situation. If you are trading be it in the FX market, means the dollar, hoping the dollar actually go up or come down, have a view, or trading the stock indices. Okay, so during this point in time, right, we know that either you trade before the event means before the event. So if you trade before the event over here, if you have either make or loss, you get out. All right. Or some of us may anticipate the event. Okay, so when you try to anticipate the event, this is the big risk. That means if because the event could actually swing, because the swing could be wild during the short-term intraday movement. So when it comes towards this situation over here, let's say if you want to anticipate the event, that means we enter the trade ex ante before the event took place, means before Fed FOMC minutes meeting, before Fed FOMC announcement. That means we could actually, because they'll be very volatile, we could, the prudent way is to reduce the position sizing. All right, reduce the position sizing, because if we are correct in our view, we allow the volatility to actually cover the amount. That means instead of entering 2 units that we could enter based on the risk reward ratio calculation, we only halve it by entering 1 unit. Let's say, for example, of euro dollar. I said to go long, we have to go long on euro dollar. So if the euro dollar goes with our direction after post the Fed FOMC announcement, that means it tends to be quite volatile. So we allow the volatility to actually cover the 1 unit of shortfall, right? That we normally we could that we actually could enter based on the reward risk ratio calculation and the 2% risk capital. So this is how I manage my risk. If there's what we call impending announcement or impending key events that could impact the instrument that we are trading. So very similar if you are trading on earnings for stocks. Let's say, for example, Alibaba. Alibaba tomorrow is actually there's a key earnings announcement. That is going to announce its earnings tomorrow after the Hong Kong session closes. So let's say, for example, if you were to actually trade on Alibaba before the earnings over here, we got to manage our position. Actually, you're trading the short term. If we are looking at because we call it to anticipate the movement of Alibaba, we call it after the earnings take shape, we could actually see a volatile move in the price, either up or down. All right. So to actually yes, we got to actually have it in a nutshell, right? That means if you try to anticipate the trade direction that could be impacted by the earnings announcement or whatever key events, that means we keep the trade. That means we enter in the position before the event took place and hoping that we get it correct after the event. So when we're actually looking at this kind of trading strategy, right, or this kind of trading move, is more prudent for us to actually reduce the trade size. All right. Okay, then do you keep a trade journal for every trade? How does that help us? Oh, definitely. So if the key thing about keeping a trading journal, right, is a reflection of your trading strategy. So let's say, for example, keeping a trading journal is actually good to actually tell us why did we enter that trade over here. Is it based on XYZ reason? It could be based on intermarket correlation that you actually enter that particular trade from there. So this trading we call journal, it actually keep track of, number one, if you do it a proper way, that means it keep us a record. It's a record keeping tool that allow us to reflect back our trading behavior and the trading strategy that we use. Does it work at the point in time that we use? So let's say, for example, we look back over here. Let's say if the trading strategy works over here, but why you are not making more? Or is it because you actually take profit too fast? So these are the things that we could actually we call it find out, or I would say that to actually decipher is through proper recording of our trading action, so that we can actually look back to find out, hey, is this particular trade strategy work well, and especially because it allows us to lock in the time of entry and the time of exit. And sometimes we can compare that if this particular trading strategy that I use, I hold a longer period of time, I may tend to actually make much more than holding only a short period of time. So the only way to actually have this particular we call it analysis, or what I call and this kind of observation, is to look back our past trading records. Then from there we're able to start to decipher all these kind of interesting factors of behavior that starts to emerge from there. Okay, so can we just set 2% risk per trade, meaning every entry price minus 2%, and that is the exit price when the market turns down? Is it easier but not a good practice? I try to paraphrase what you mean from here. Is that we wish, can we set 2% risk per trade? All right, then the entry price minus 2%, and that is the exit price when the market turns down. Is this easier but not a good practice? Actually, I don't get quite your question. Could you maybe paraphrase it by some numbers? So I could, okay. So what I mean is that we set 2% risk per trade, okay, meaning entry price minus 2%. Oh, okay, I know what I mean. So you're saying that you get your entry price minus 2%. Every trade just minus 2% off the entry price. Okay, so let's say for example, you're entering $100 per trade, you minus 2% off the entry price. Okay, so by doing this over here, right, one thing, you can't calculate your position size, because the 2% risk, right, is I want to know what is the maximum loss that I could take for that trade. So at the end of the day, right, if I have lesser trading capital, so definitely the trading, that means, let's say for example, if my next, okay, the thing about this 2% is over here, it helps us. Okay, let's say my trade itself, right, my first trade I make a loss, all right, so my trading capital will be lesser. So it tends to actually force us, right, to actually take a smaller position in our next trade, all right, because it's always 2% of the available trading capital. Yeah, so I think that is a more prudent way to actually do a proper risk management, rather than getting the entry price minus of 2% of the entry price, which is at the end of the day, right, you may overtrade that, because yeah, there's a risk. If I have 5K to start, how many stocks or counter to spread the investment? Okay, so based on 5K, right, so we're talking about, if you're looking at 5K, so if you add a bit of leverage, well, let's say of leverage of, let's say 5 times, so that would be 25K. So let's say if you do a bit of leveraging with the account, so I would say that prudently for 5K, right, at any one time, not more than three. I mean, not more than three instruments to actually look at. All right, so this is pretty prudent. At least not more than three to actually look at at any one time. That means at any one time, it shouldn't be more than three open position. All right. So how do you spread? Okay, so we're talking about spreading, right? Okay, so now, so firstly, the first one I talk about is not more than three open position at any one time. Then the next thing is how do you want to spread your risk on stocks or thing. So let's say, for example, what this if you are trading definitely equity over here, let's say equity itself, let's say US equity, definitely you do not want to have all three trading in tech stocks, right? Because at the end of the day, if you take all in tech stocks over here, there's a risk for if you have a view that all of them are bullish, you trade the bullish view, or three tech stocks over here, there's a potential possibility that you'll make a loss out of these three over here. Okay, so definitely I would not want to actually look at this situation if we are talking about this approach over here. That if you are talking about I mean, you got to spread out. If you have a view, we call it concentration in terms of the stocks itself. See, so if you're talking about stocks over here, definitely we want to diversify across different industry to trade, or unless you're doing a bit of hedging. Let's say, for example, that this you have three tech stocks to look at. let's say then all of them tend to move in a similar correlation over here. So these three tech stocks over here, right? These three doesn't necessarily you need to go long. Two could be long, one could be short. So at least there's some hedging. But when you do this kind of hedging, it's pretty dynamic. That means you got to constantly monitor that position. They all depends boil down that do you have the time to actually monitor that? Okay, so now stop loss in system. Is it possible the system will not trigger? Okay, stop loss in system. Is it possible the system will not trigger resulting in loss? I do not. Okay, stop loss in system. What do you mean by stop loss in system? Sorry about that. Is it possible the system will not trigger resulting in loss? Perhaps you could paraphrase that question. I don't know what you mean. Stop loss in system. Okay. So, okay, do you set a target time frame to exit trade if price do not move or move too slowly? Okay, so this okay, this particular exiting of time frame, right? Okay, so it all boils down right to initially, right, what instrument you are trading at and your initial trading plan. Your initial trading plan is very important. So let's say, for example, right, if you are trading at a position on so let's say, for example, you are trading very short term. Okay, so short term, by short term, that means you don't want to hold your position overnight. Okay, overnight. So this is not stocks, this is nothing. So let's say talk about FX. So FX itself, right? I want to get maybe let's say I trade particular the euro FX now over here. Let's say I long euro dollar right now, hoping to achieve a pip of 60 pips. Okay, you all know that FX market, right? The liquidity tends to die off once the market goes into the after the first half of the US session. That means Singapore time, once it reaches about 12 a.m. or 1 a.m., the liquidity of the FX market will start to die off. Unless there's impending news out, which is the Fed FOMC. Let's say there's no impending news. Let's say when it hit 12 a.m., your euro dollar hasn't hit 60 pip from target. You only hit 40 pips. So your initial aim was actually to hit 60 pips, but you know this is a very short-term instrument. Once the liquidity die off, you will not hit 60 pips. And tomorrow morning, it'll be a different ball game because of the high volatility. So this is where I want to exit my position. So I got to have a time frame to actually cut over here. So it all depends on the instrument that you are trading. That I could give you the answer. So the instrument I shared just now is the euro dollar FX. So now if you are trading on stocks, right, it's a bit different. Why? Because stocks, right, you want to ride the trend of the stocks over here. Trend of the stock. So once a stock trend develop, it can persist and it can last for weeks, sometimes into months. Okay, depending if you are looking at the trend of that particular stock over here. So let's say, for example, if you are trading on a stock, let's say, for example, on DBS in the last few weeks or months, you've been trading upwards, right? So let's say, for example, over here is that the key thing for us, you got to ride this trend until it ends, right? So how do you know the trend over here starts to change is by looking at momentum. So momentum tends to lead price movement. So let's say, for example, if you, I'll give you an example because okay, you long DBS at a particular price of let's say maybe $20 or whatever. So the price you have a target of let's say $25 or $30. Okay, so let's say $30, 20, 30, yeah. So price moved to 25, 20 to 25 really the money, but hasn't hit 30 yet. But however, then it starts to slow down. Okay, slow down for a while. Then you realize that because your initial aim was actually based on the calculation of the price behavior hitting 30 based on the ATR, it should reach within 3 weeks. But now it comes to 3 weeks, you haven't hit 30 yet. And you realize that hey, this trend start to, perhaps the trend may start to change, or because there's a risk, there's an impending risk due to some news that is or earnings that is coming out of DPS that could actually prevent people to be more aggressive to bid up the prices higher. So all this, right, you got to take into consideration of what kind of instrument you're looking at. Or perhaps, right, the trend of DBS starts to change, or there'll be a possibility of a sideways movement by looking at the momentum indicator of DBS, like the RSI or the stochastic. Okay. So last two questions before I go. Okay, Singapore market is bullish now and US market tanking. Do we switch to the Singapore market to trade or wait for US market to recover? Okay, so this is a question, right? Uh, I got to ask myself over here, is it worthwhile to take the risk of the Singapore market right now? Because yeah, I know it's bullish. Okay, so if bullish over here, right, we got to look at what stocks you are looking at. Yeah, I know it's bullish in the raw general. Is the reward risk ratio good to attempt the trade right now? Okay. And the next key thing, talk about the US market. Yes, US market is tanking over here. Yep. Then I'll ask myself, in order to trade this tanking US market, if it comes close to support at this point in time, do I want to take a position? Because the reward risk ratio is good, but the volatility is high. Then I ask ourselves over here is that what kind of trader I am? I am a trend trader, or I am a trader who is very good in exploiting short-term movement in price. That's the question that I got to throw yourself back. So I'm if I am a trend trader, I'm not comfortable in trading short-term price movement to capture the high volatility that the US market is experiment right now. An example, you look at SPX 500 last night, it actually tanked down initially, but it went up towards the close. So is my trading style suitable for such trading environment? I got to ask myself. If you're not suitable, then you got to switch to a market that is trending. That means there's clear trend to actually have a proper formulation of that trend. I mean, to have a proper trading setup to actually trade according to that trend that is the Singapore market right now, which is in an uptrend based on the previous stock. Then you've got to ask ourselves, the key thing is this uptrend over here, because it's been uptrend for a while already, is this uptrend about to end? Then to answer that question, right, it's more about trading strategy. So you can pierce together momentum indicator. Is this momentum strong, or has the momentum turned weak? Or if you certain stocks, for Singapore stock, you find that hey, it's been up for close to 20 or 30% for now, can it go up higher by another 30 or 20%? It means the hurdle get harder. So perhaps if I'm trading short term, I may want to nibble slowly, rather than going too aggressive if I miss out the earlier boat. All right. Okay, one thing, let's say you have a stop loss in the system. Will the system miss the stop loss trigger? Okay, the key thing about this stop loss is if you do not have a guaranteed stop loss, there's a risk. Okay, let's say what my guaranteed stop loss is. Let's say if you place a stop, okay, let's say example, I'll give an example. If you enter a stop at $2, you have a stop loss at, let's say, 150. Okay, 150, yeah. So you place a stop at 150 over here. So sometimes, right, you know that stock's price, right, stock itself based on exchange traded. So let's say, for example, if the exchange is closed already, the exchange is closed. Let's say you are trading in the Singapore market whatsoever, $2, enter $2, 150 stop loss. Okay, so let's say the price now from $2, it actually went up to 180 when the market closes. Okay, so you have 180, 150, you make a loss, but you haven't hit the stop loss at 150. But what if tomorrow market Singapore opens, that particular stock get down to actually 130? That means it goes beyond your stop loss, right? Because it's not a guaranteed stop loss over here. Instead of hitting 150, it actually hit at 130, which is the best available price. That means your initial expected maximum loss actually gets bigger because of this gap down. Okay, so in order to prevent, it will miss out because there's no price, the price just gap down from that. So the key thing is to prevent yourself from this gapping down. I mean, the only way is if that particular instrument has a guaranteed stop loss in the system, you can actually place a guaranteed stop loss. So instead of hitting at 130, you will hit 150, but you're going to pay a slight premium of that because it's like an insurance. You'll pay for a slight premium once this guaranteed stop is being activated. Does CMC platform have the function to set a trailing stop at this moment? So this one over here is that I could not, this one, yes, there's possibility, but perhaps this one I could actually direct you all to some of the trading platform tutorial from there. So from there, you're able to have a better picture on how to use that particular trading stop loss system at this moment, at this point in time. All right. Okay. So we come towards the end of that particular presentation over here. So before we go, right, let's take a look at I will share with you this will be my Twitter handle. So right, what you do over here is for those who want to follow me, so this will be my profile. So just open a Twitter account. It's free. So once you open a Twitter account, you actually follow me at just type it at Kelvin SC Wong. You should follow me. So you're able to see my daily tweets that I tweet every morning. Okay, before the at around 8:30, at around 8:30, yeah, 8:30, yeah. So these are the overnight events, things to happen, sometimes things to watch out for. All right, from that. Okay, so this is how I actually this is where you can actually get updated on the what you call it, the what's happening in the marketplace. And I also upload what I call this kind of webinar into the Twitter handle as well. And also every morning, okay, not every morning, every okay, I'll go again. Every Monday, I will actually have the weekly technical outlook on the major stock indices that I cover. Okay, over here. So this you can actually take a look. It's also the link of it's a YouTube video. So highlighted the key levels actually to watch for the week. All right. So so great. So great Twitter updates. Keep them coming. Well, thank you very much. So yeah, we come to the end of this webinar. So I will actually upload this webinar to my Twitter account as well. So for reference, you can actually take a look. And I hope that the risk management technique I share with you all could actually add some greater value or make a positive value in our we call it trading journey from there. So thank you very much and have a great evening ahead. And I see you again in my next webinar. Thank you and good and have a pleasant evening. Yeah.